Welcome to our discussion on valuing corporate bonds. Bonds are a fundamental part of financial markets, serving as a primary method for companies and governments to raise capital. By the end of this chapter, you should be able to identify and discuss the key characteristics of bonds and bond terminology. You should be able to understand how bond risk is rated and how these ratings influence borrowing costs for companies. Building on our objectives, we will also talk about how is debt actually retired, how do we value bonds and calculate yields to maturity, and we'll discuss the concepts of duration and interest rate risk. Before we dive in, let's clarify some key terms that we've used throughout this discussion. A bond is a debt security issued by corporations or governments to raise capital, maturing in more than 1 year. A covenant is a promise. These are the terms that are agreed upon by the bond issuer and bond holder. They can include restrictions on further borrowing or dividend payments. Price sensitivity. The degree to which bond prices fluctuate with changes in yield. Longer-term bonds and lower coupon bonds are more sensitive to changes in things like interest rates. Private placement. This is a circumstance where a bond issuance is sold directly to a select group of institutional investors rather than the public. Although this sounds like it's a little bit of a backdoor sale, there is some very restrictive rules that go along with purchasing something in a private placement. Public offering is when the bond's issuance is available to all investors through open financial markets. Bonds have several fundamental components. The principal is the amount that's borrowed by the issuer, which is repaid at maturity. Sometimes we refer to this as its face value. The specific value for most corporate bonds is $1,000. And indeed, bonds are typically all sold in some function of 1,000, maybe 1,000, maybe 5,000, maybe 10,000. There are some bonds, though, that could be different. These are what we refer to as United States savings bonds. Those bonds can be purchased in increments as small as $25, but they are not the same as corporate debt. Yield is one of the most important factors in bond investing, as it determines or it identifies an investor's returns. The current yield is calculated by dividing the annual coupon payment by the bond's price. It gives a snapshot of annual income, but does not reflect capital gains or losses. The yield to maturity considers all future coupon payments and the final repayment of the face value, discounting them back to present value. The yield to maturity provides a comprehensive measure of the bond's return if purchased today and held to maturity. If an investor buys a Tesla bond for $950 with a 5% coupon, their yield will differ from the stated coupon because they purchased the bond at something different than $1,000. We'll discuss how prices, values, investing all relate throughout the rest of these videos. A yield curve plots bond yields against the time to maturity. Typically, this curve is upward sloping, meaning that longer-term bonds have higher yields to compensate for increased uncertainty. The United States Treasury yield curve is one of the most important economic indicators, reflecting investor sentiment and expectations for inflation and growth. As we see, we have three different curves here from different time periods. You can all see that 1 month yields are much lower than outward. You notice there's different slopes, right? Different timing here, obviously, different values. This is all part of the impact of the macroeconomic environment, the Federal Reserve's changes, etc., on the Fed funds rate. But in general, an upward sloping curve indicates that investors are anticipating future growth in the economy and or inflation. Sometimes in history, we will see what they refer to as an inverted curve or a negative yield curve. And again, you see, when we say negative, it's not a lot negative, right? It is a very flat slope, but definitely downward sloping. There are certain times that this happens. Typically, it is a predictor of upcoming economic downturns. And this has happened again several times throughout history. In 2000, that was a result of the dot-com bubble burst. 2007 was because of the global financial crisis. 2019 was just before the COVID pandemic caused all of the economic disruptions that came along with it. So a negative yield curve can give us a picture, at least how investors feel about what the future might bring us. Interest rate spreads measures the difference between long-term and short-term bond yields on sometimes the different ratings, if you will, or different types of bonds. As you notice here, the difference between years, the spread is this line here, indicates if you take the high yield minus the low yield, that gives us then the yield here, or the spread. If the spread is narrowing, it can indicate some economic uncertainty, while widening that spread often signals economic expansion. If these spreads are carefully analyzed by economists and investors to kind of gauge economic market conditions. Excuse me. What is an indenture? An indenture is the future contract outlining bond terms. It indicates key elements such as the coupon rate and maturity date, any restrictions that might be imposed on the issuers of the debt. There could be some collateral details. There could be indications of limits on paying dividends by the issuer. So Boeing's bond indentures often restrict the company from excessive new borrowing to try to maintain and help maintain its creditworthiness. If companies can just borrow as much as they want whenever they want, that increases the risk of the debt that they already have, which obviously has an influence on the value of that earlier investment. A trustee is usually a financial institution that tries to ensure bondholders' rights are protected. They oversee the bond payments. They notify bondholders if there's a violation. And in the case of default, they represent the bondholders. they kind of act as a referee, right? The bond issuer has to follow the rules of the indenture. But there are many, many bond holders. So we don't have the ability to track and make sure that the loan continues and is stable. That's the job of the trustee. They work for the bond holders. So let's think about risk. What risk elements are there in bonds that might not necessarily be in stocks? Well, the first is something referred to as default risk. That's the possibility that the issuer cannot repay principal and interest. We'll see how we measure this and how it's published so that we understand in the next couple of slides. Price risk, that's when the price of the bond changes when interest rates change. If interest rates increase, bond prices decrease, and of course this is bad for bond holders. Inflation risk. Purchasing power of the payments are going to decline over time because of inflation. This risk must be incorporated into the ongoing pricing of bonds. There's something called retirement risk. What's the chance that the company will retire the debt early? Now, the bondholders get their money, but the challenge is they have an investment strategy. They wanted these bonds for 30 years, and the company now decides to retire in 15. That has messed up their strategy. We also have interest rate risk. Again, this has to do with when if you lower interest rates, then future proceeds are going to be invested at lower rates. This is if you longer you hold a bond, this risk says you may not be able to get as high a return as you thought because you won't be able to reinvest and get your compound return at the higher rate. And of course, if we invest in foreign currencies, we know that there is an exchange rate risk in foreign currencies. How we measure default risk or how we identify this is through something called a bond rating. Several companies rate bonds to help investors assess their risk. AAA rated is the highest risk. We refer to them as having the highest quality. This means they have the least chance of default. Anything that's triple B or above is what we refer to as investment grade. This is where a majority of individual investors should be purchasing debt. Below triple B are what we refer to as junk bonds or high yield securities. Again, these three organizations, they don't always agree identically as to the rating, but they will be very close. They will not be very far apart. So here's an example of a couple of bonds and their ratings. If we just look at a couple here, we see here is the 3M company. They have a coupon rate of interest under Moody's. Their coupon rate is 3.05. They have an A1 rating. S&P has them as A+. Apple, coupon rates 1.65. AA1. AA plus is the S&P rating. I think S&P makes it a little bit easier because they designate these as in these categories, if you will, right? So you have AAA, AA, triple B, double BB, C, etc. And then they give the plus and minus signs if you're at the upper end of that particular rating. And what we're looking at here and how these companies analyze this is through financial statement analysis. This is obviously published all the time. When companies have a change in rating, that is a major economic event for that company. It will affect not just their bond prices, but will also affect their stock prices. Look forward to seeing you in the next video.